All right, let's talk about the January 2022, what happened. Want to also remind everybody to subscribe to our YouTube channel. And also you can go to our website and under HG-TV, you will be able to see all these different playlists of the videos. Or if you're more of a reader, you can go to our the blog. This is where we actually type up everything that we share with you on this webinar so that you can read instead of watching the video. Last time I showed you guys like the first weekend of open house, people were lining up out the door. And in just the last 30 days, a lot had happened. Their market's just flying off the shelf still. A lot of listings, to be honest with you, don't even get to the market, and people are already making offers left and right. And as an example, single family here, West San Jose sold off market, and then a townhouse in San Jose got 5 interested preemptive offers. Literally, we have to like stop them from submitting the offer until the deadline, and at the end is sold 20% over asking. And I don't know if you guys can see this. This is a fixer and it's staged. I honestly don't think that they needed to stage this, but it's a 2-bedroom, 1 bath in Sunnyvale. Asking is 2.3 with mold, if you can see that, of the mold. So, but of course, people are buying this actually to redevelop, to build a home, their dream home. So just to show you guys how crazy the market is. And for a property like this is a 9,000 square feet lot, and they are able to build like 3,500 square feet house on this lot. So it went under contract really fast though, within 7 days. And knowing, you guys have to understand though, properties like this, with peeled paint, with mold, typically you cannot get conventional financing. Most of the time you can only buy with cash or hard money lending, mainly because conventional lenders, they cannot lend you on a home that is not considered livable. So having mold in there, having peeled paint, that's considered health hazard. So that's why they would not lend it on these type of properties. So if you do find properties like that, I know a lot of our clients say like, we would like to buy a fixer upper. There's different level of fixer upper. This level of fixer upper, you will have to consider using a hard money lending or some kind of bridge loan who actually lending you the money based on equity instead of based on the loan to value. So if you do have any more questions about that, of course, feel free to let us know. All right. So what about like all these offers? It's been crazy. If you talk to our team, I can tell you everybody's been so exhausted. Offers one after another, and just keep getting bid out. And the thing is, you can't even comp it out anymore. We unfortunately, it's really unfortunate. We have to tell our clients like, well, you know, you kind of have to expect to pay $200,000 over the appraisal value. Why is it so important? Is because the bank, if you're doing 20% down, the bank would only loan up to 80% of the lower of the purchase price or your appraisal value. If it does not appraise, then that means you have to pay 80% of the appraisal value and then pay the difference. Now, it is dangerous if you don't understand why that can make a big difference, because if you don't have enough money in your bank account to cover that difference and you have made a non-contingent offer, you may not be able to get the loan, and it will be, you know, you'll be risking your 3% earnest money deposit. So again, if you take a look at this, so many properties had gone like something like this, $400,000. We don't even know how much it has gone over for Pleasanton, and in Fremont Mission area, another $360,000 over, and Lum Rock is $250,000 over, and West San Jose, this one's 30% over. So during coming soon, not even on the market. And look at this one, Almaden Valley. They sent us 65 disclosures. They received 22 offers, and 7 of them, even though asking price is 1.575, 7 of them, they were willing to pay over $2 million. And we know for a fact that when we did the comparable analysis over here, the comp is like around $2 million. That means appraisal, we think, is going to be around $2 million, but still 7 of those 22 offers were willing to pay above and beyond the appraisal value. So here, just some example. I know it sounds a little bit discouraging, but I guess if you look at the multifamily side, it's not as crazy. This like for example, Campbell, the asking price 2.688. They did get 6 offers, but their offer price is not as aggressive. Some of them actually made offer below asking price, so it just barely went over the asking. Same thing for Redwood City, it actually got accepted slightly below asking price. So just single family definitely is a lot more hotter compared to multifamily and townhomes, but then it's still, there's just so many demands. A lot of them actually are making offers before you even hit the market. So then you got to ask, like, so how do I make an offer, on properties that are not even on the market, right? Work with your realtors. They have access to some of the off-market properties. I know if you're looking on Redfin and Zillow, you may not be able to see everything, because if I'm looking at my database, there's 158 off-market listings right now in Santa Clara County for single-family homes. And out of these 158, actually, since last housing market update that I provided you, they added 123 of these off-market listings. And some of them you can start showing, some of them they're not ready yet to be shown, but be sure to work with your realtors and make sure that they are sending these listings to you guys. And for condo and townhomes, same thing. There are 73 of these off-market or coming soon listings. And since last housing market update, there were 61 added into the database. And how many of them have sold off market? To be honest with you, and relatively speaking, it's really not that much, because there are only 26 of them actually went under contract for single family homes. And then if you see contingent means they actually have contingency. So when you're off market, believe it or not, you actually can have some kind of contingencies, because they probably don't even have all the disclosures, all the inspection reports yet. So if you're buying off market, there's still chances you can actually put contingency on there. But of course, most of them are still pending, meaning all the contingencies have been removed. And as for condo and townhomes, as you see here, same thing. AC means active contingent. So there are contingencies on here. And then pending means like there's no contingencies. There are 11 of these listings off market that never shown on public portal that had gone under contract. So all right, so you do see that people are able to buy off market, and we have helped quite a few clients to do that as well. So how about looking at what is the inventory level, what's going on? Here is, today I'm going to use the chart a little bit different from before. If you look at the blue bars, it says number of new listings, and then versus number of contingent and pending listings, meaning that how many new listings came out and how many had gone under contract, right? And we looked at these numbers before already. You see that December has gone down quite a bit. And then all of a sudden, January start, what happened? Sellers are ready to sell, right? So a lot of them started to come onto the market. These are the new listings that came on the market. And then we have 542 versus 777 properties that actually gone under contract. But if you look at the inventory level, this one I added this bar, it was from last, basically January 2021. We are still quite a bit below last year January numbers. We are about I would say 150 listings less compared to last January. So this is also why you see how crazy that we are to bid for these properties. We're at 13% now, way higher than the last 12 months. We're at 13% over asking in order to win these properties. And if you look at every January, if we just look at every January, compare how much listings, as I mentioned earlier, 2021, we had almost 900. And then this year, we only have 777 units. But if we look back to the last 5 years, we're actually not too bad. It's just last year, we had a lot more listings compared to the other years. And then what about February? February, it's, you see, compared to January, we always have a little bit more, because that's when sellers are getting ready and then they are ready to come up on the market. So in February of 2021, we have about 1,000. This year, we expect, again, just like January, we expect less than last year, but it should be going up towards more about 900 something listings, new listings going to come onto the market. All right, so what about condos? Same, very similar scenario. We have quite a bit of new listings coming up compared to December, more than double for condo and townhomes. And condo and townhomes are a lot faster, right? When we prepare those properties, pretty much clean it up interiorly. We don't have to do any exterior work. So that's why you see that they pop up a lot faster compared to single family. And we do see a lot of people are buying these. And as I showed you earlier, some of the townhomes, they're still getting multiple offers. And if we, again, compared to last year, we are also have less new listings compared to last January. Just like single family this year, because we have less listings, you see the competition level is also higher. Not as bad as single family, we're at 5.4% versus the 13%, but still much higher than the last 12 months. And here you go, you see the pricing, the number of units over here. We are actually more than the last, well, more than 2017 all the way to 2020. 2021, again, we have had a lot higher listings compared to the past few years. So this year, we're still not bad. We have less than last year, but we are still more than the past 2017 to 2020. And in terms of the competition level, in 2018, that was the one that has the highest sold over list percentage because it has such low inventory. So right now we are still around 106% over asking. And February, so you kind of get a sense now that February, we're probably going to have slightly more still compared to last year. And just know that your competition level is probably going to be around the same 5% above asking price. And Alameda County, we have very, very similar situation. The January listing also had come up quite a bit, but then it's still shy of what we had in January 2021. So it's really across the board throughout the whole Bay Area. But there, they had Alameda County is really interesting. Last year, it was so competitive, right? If you remember just now, we were talking about Santa Clara County, we were 13% over, and which was like the most competitive in a while. And Alameda County, last year, they were very, very competitive, but now this year actually came down a little bit. They're not fighting for the property as hard. We're going to see if it's going to continue this trend, but either way, they are still over 10% over asking price. So it is still very competitive. It's just, we're just comparing historically, whether it's more competitive or less. We used to hear a lot of people saying like, oh, it's fine, we can live a little bit further out. But recently we started to hear people start thinking more about, hey, I might have to go back to the office, so I might have to live a little bit closer to public transportation or shorter drive. So it seems the trend is coming back to saying like, I need to be a little bit closer to work. And condos, it's the same thing. Condos, you see that it go up quite a bit, almost double. It's not as competitive in terms of, it's not over 10% asking price, but it's about 4.8 over asking price in order to win the properties. And San Mateo, we went from 169 units to 332 units, new listings in January. And then as for the how competitive it is, right around 10%. It's been pretty consistent since last year. It's right around 10% over asking price. And their condos, this has way more than double, from 68 units in December went to 164 units in January. So that you probably can find a little bit more, I would say a little bit less, less competition. So you don't have to bid as hard. So as you see here, it's only about 3% over asking. So I think in San Mateo County, the condos and townhomes are less competitive, or you don't have to be as stressed out if you're bidding over there. What about the mortgage loans? I've been waiting to see if I can find more updated mortgage rates because I mentioned last month, due to inflation, I expect their projection is going to be higher. Mortgage Bankers Association and Fannie Mae, their projection stays the same. So they are still projecting about 3.7 on average by the time we hit 2022 4Q. I still have a feeling that it's going to be higher than this. So we'll see if they will change the projections in a month or two. And this is a trend line week after week since September, as you see how the rate has gone up quite quickly since December. So now it's already at about 3.56, while I asked my friend from Wells Fargo, Victor Chow, and he sent me the rate late last night. And the jumbo loan, 30 years, is at 3.375. I remember in the beginning, we've been talking a lot about 2.875, 3.125, and now it's already at 3.375. And also high balance conforming loan is now at 3.75%. So it's getting closer to the 4% range. And now here, Mortgage Bankers Association, their economic forecast, this is on January 21. As you see, they are projecting employment rate is getting better and better, but you see the Fed funds rate, of course, is going up as we had predicted, right? And that's going to raise, probably the first one's going to come up in just a few weeks in March. And then the 10-year Treasury yield will continue to go up as well, which correlates with, I should say, mortgage rate correlates with the 10-year Treasury yield. And it looks a little scarier when you keep looking at the Fed fund rates. It just really keep going up and up and up and up like this. But so, I mean, and even 2024 is going to go up to 2.125. But I know it looks really scary. And that's because we're so used to seeing a Fed fund rate is close to zero. But let's look at what other people are saying with these rising rates. So they're talking about they might have 7 rate hikes. And this is probably the most common question with this, like fast rising wages could cause the Fed to raise interest rate even higher this year. So what would happen then? As a matter of fact, they are really thinking about that. This whole rate is going to go faster than we thought because inflation is going really high. The housing market is super hot. But if you ask the chief economist of Fannie Mae, he actually said that there's no expectation that prices will fall. But our forecast suggests that the price appreciation will slow. That is for sure. Price appreciation will slow. It's not going to go up like 20, 30%, double digits like we see right now. But then the price, will it crash? I think that's the question. Will it crash? We've seen a lot of reports. Most of the economists don't think that the price will crash. A lot of our clients also ask us this question. So when you want to know, when you think about, will the real estate market crash because the interest rate is going to go up, then especially, by the way, what we are sharing here is very local. We're not talking about nationally. We're talking about Bay Area only. So you want to ask is that, do we still have enough demand in the Bay Area, right? And if we have demand, then the market shouldn't crash. So, I mean, knowing if there's demand, we need to know whether people are going to stay here in the Bay Area. But why would people stay here in the Bay Area? Only if there are jobs. If there are jobs, then of course people will stay. And that means we need to find out whether these companies actually are leaving or are they staying here in the Bay Area. So that's when I started to dig in a little bit more what's going on with our California market. And one thing is that we look at the Fannie Mae report, and they had talked about the select markets with higher expected 2022 employment growth. And of course, San Francisco, which is the Bay Area around here, they are part of the top 10. If you want to know which ones are lower than expected, these are the Philadelphia, Indianapolis, Cleveland, Pittsburgh, Virginia Beach, St. Louis, Missouri, Chicago, Birmingham, Hartford, and Kansas City, Missouri. And also, as a matter of fact, next week, we're going to be doing an event with a few commercial real estate and residential real estate professionals, and one of which he is actually from the Greater Sacramento Economic Council. And as I was talking to him, I found their website, and then I saw this chart, and I was pretty surprised because it's saying that the effective business tax rate in California is actually lower than Colorado, Arizona, Washington, Texas, and Nevada. And I just couldn't really believe it because we are so known for a high tax rate over here, right? And then also they talked about like how many cents per dollar reinvested into businesses, and California is actually doing better, higher than Arizona, Nevada, Colorado, Washington, and Texas. So this is a report by Ernst & Young in 2018. At that time, that they're looking at why are people doing business in California. I know there are a lot of more regulations, and a lot of people are frustrated. But then I think at the end of the day, businesses need to think, where can they make the most money, right? So this is really interesting. Although I have to say though, the business tax rate, this probably doesn't apply to small businesses. So if you're small businesses, your tax is probably higher, but then it really works for the larger corporations who are staying here and which will be the one that supporting the employment in our area. And here is another chart that I found from Ernst & Young, their reports. This is back in October 2019. And this is looking at the total effective business tax rate by state. And the lighter the color, the better, the lower effective business tax rate is. And I was totally expecting that California is going to be dark blue, but it's not. It's actually, they are around this. They're not the lowest, but then they are relatively low. So this is also another reason why we don't think that companies will actually leave California, even though it does seem like it's really attractive to go to Texas, which is actually have a more effective business tax rate. And we have to also think about like other states. Sometimes they don't have income tax rate, let's say, but they do have much higher property tax rate. For example, in California, we're right around low 1%, but in Texas, some area is as high as 3-point-something% for property tax rate. So they do make up in certain areas. So this is one of the reasons why I thought it's really interesting to show you guys. And I just found all these reports as well. I just thought it would be great to share. And also another article I found by Matthew Winkler. he also talked about like, why is it that, everybody talk about California has such high tax rate, there's so many regulations, they keep saying like people want to move out, but then what's going on? How come California is still so strong? Some of which it says like the most trusted measure of economic strength says California is the world beater among democracies. The state's gross domestic product increased 21% during the past 5 years, and dwarfing number 2, New York, 14%, and number 3, Texas at 12%. The gains added $530 billion to the Golden State, and 30% more than the increase for New York and Texas combined, and equivalent to the entire economy of Sweden. And this is how strong California is. And also it says, for all its bluster as being best for business, Texas can't match California's innovation. California prosperity is rooted in its appeal as a worldwide destination for technology and healthcare development. Of the 6,924 corporate locations in the state, 18% are research and development facilities, a ratio that easily beats the US overall 11%, China 15%, UK 14%, and Japan 10%. Only Germany at 19% has a high rate, according to data compiled by Bloomberg. And the percentage of Texas facilities for R&D is less than half California's at 8.2%. I thought these are really, really interesting articles and how they break it down, why California is so strong. And then, and of course, when you are a company, you also think about like what kind of revenue you can get per employee. And this is the line for California. As you see that the revenue per employee is much higher than the national average. So I hope you guys find this interesting too, because I was just kind of like, always wonder whether companies are really going to leave California. So with that said, should you buy more investment properties then, or just real estate in general? I want to share a little bit with you before we go into, because today we are talking about cost segregation. Cost segregation applies to your investment properties. So let's think about whether it is time for you to go into investment properties. Now, one thing that when we buy investment property, we do look at cap rate. The cap rate is still trending down despite the Fed rate is going to go up. The rents is also continued to go up, and it's actually going up pretty high, especially for multifamily, went up 11.3%. And also the treasury interest rates and multifamily cap rate, you'll see that the cap rate is still maintained pretty low. They don't think that the just because the 10-year treasury yield is going to go up, that is going to actually affect the cap rate. So in the future, the cap rate is still going to maintain pretty low. So with here, you see that the line showing the vacancy also has come down quite a bit, while the rent has gone up quite a bit also. If you're deciding between Class A, Class B, Class C properties, the national effective rent growth for Class A and Class B properties definitely had gone up a lot more compared to Class C properties, especially because of the pandemic. Unfortunately, the blue collar or the lower income population got affected the most during this pandemic. All right, so the conclusion here, after looking at all that, is that the businesses most likely in the Bay Area are going to stay, because California is still a very ideal place for them to make money, right? If they want to have business here, obviously they have to think about making money. The supply level is definitely going to increase modestly. Mortgage rate will increase in 2022. Rental rates that will still remain really strong and go up. Cap rate will remain low. And more importantly, there's also a lot of tax benefits in 2022 that Geraldine is going to go into a little bit regarding that. And housing prices will increase gradually, but we're probably going to start seeing listings will stay on the market longer. I would think that around June 2022, that's when we start seeing that the market is going to slow down. Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.